When we think of the Federal Reserve, we picture this single, powerful institution, right? Making these huge decisions from some marble building in Washington. But what if I told you the Fed wasn't born that way? What if it was actually born from a bitter fight, a forced compromise that basically hardwired a deep, structural conflict right into its DNA? A conflict that, during America's darkest economic hour, literally turned the Fed against itself. Yeah. To understand the Fed today, we've got to go back and uncover the story of its birth.
Okay, so think back to the 2008 financial crisis. The Fed faced an absolute storm of criticism. You've heard all of these arguments before, I'm sure, that the Fed kept interest rates way too low for way too long, just pumping air into that housing bubble, that its regulators were totally asleep at the switch, and of course that it bailed out the very Wall Street firms that caused the whole mess, creating these massive conflicts of interest. I mean, these are serious charges, and they've fueled calls for major reform ever since. But here's the thing. Are these really modern problems? Are they unique to the 21st century? Or are we just hearing the echoes of a much, much older battle?
And this is where it gets wild. If you rewind the clock almost 100 years, you find this quote. The exact same criticisms, the same cacophony of criticism was thrown at the Fed after the Great Depression. The arguments were almost identical. So this isn't some new debate we're having, it's the original debate. The problems we are still arguing about today are the very same ones that nearly broke the country a century ago. Understanding that original fight, well, that's the key to everything. So, to get why, we have to go all the way back to the beginning, to the Fed's fractured foundation. See, its design wasn't an accident. It was a deliberate and, as it turns out, a deeply flawed compromise. All right, so picture this. It's the early 1900s. The U.S. doesn't have a central bank, and its financial system is just chaotic. It's constantly being hit by these terrifying bank runs and panics. But there's a huge problem. Americans, especially everyone outside of New York, are profoundly suspicious of any plan that puts all the financial power in one place. They were terrified it would just become a toy for Wall Street. So, two competing visions came out of this. On one side, you had the Aldrich Plan. This was your classic European-style central bank. Power would be concentrated in a single national authority in Washington, D.C., and it would set one interest rate for the entire country. Simple. But that plan got shot down. Instead, Congress passed the Federal Reserve Act, which created something totally different. It was this decentralized system of 12 regional banks, and each one had the power to set its own local interest rate, with this board in D.C. just kind of loosely supervising them. This whole setup was known as the Wilsonian Compromise, and politically, it was a work of art. It was designed to balance the competing interests of Main Street businesses, the powerful Wall Street banks, and, of course, the federal government. The whole idea was to prevent any single group from getting total control by splitting the power between them. But here is the fatal flaw. In trying to make everyone happy, the Federal Reserve Act left this giant, dangerous question mark right at its core. It never actually said who had the final say. Was it the regional reserve banks, or was it the board up in Washington? It created a system with two competing centers of power. And that, right there, set the stage for a civil war. So now we're going to see how this fragile compromise didn't just crack under pressure, it absolutely shattered. This wasn't just some political disagreement. It became a catastrophic failure during the country's greatest economic test. Just look at this timeline of pure dysfunction. In 1927, the incredibly powerful governor of the New York Fed, a guy named Benjamin Strong, basically goes rogue. He cuts a secret deal with European central banks, which infuriates Washington. Then in 1928, New York and Chicago can't agree on what to do about the roaring stock market bubble. And then, and this is the most damning part, in 1929, the board in Washington repeatedly vetoes the New York Fed's attempts to raise interest rates to cool things down, right before the crash. The entire system was paralyzed. Now, a huge reason for this paralysis was the death of Benjamin Strong in 1928. He was pretty much the one person with the force of personality to make this broken system actually work. Without him, a massive power vacuum opened up, and all the infighting and indecision just got way, way worse. And this brings us to the ultimate breakdown. It is March 1933. The country is in the middle of the worst banking panic in its history. The New York Fed is hemorrhaging gold. It's about to go under. It begs the Chicago Fed for a loan, and Chicago says no. It lets another part of its own system fail. And the board in Washington, it does nothing. The House was completely divided right as the entire economy was burning to the ground.
Now, to this day, historians still argue about the root cause of this failure. You have Milton Friedman and Anna Schwartz, who famously argued the problem was the structure itself. It was decentralized, it was leaderless, and it was just doomed to fail. But then you have others, like Alan Meltzer, who argued that no, the structure wasn't the real issue. The problem was that everyone in New York, Chicago, and Washington was operating under the same bad economic ideas. They all believed in this thing called the real bills doctrine, which essentially blinded them to the reality of the crisis. But look, whatever the reason, the failure was so total, so absolute, that it led to a complete revolution in the Fed's design. Basically, a full-on takeover by Washington. The Banking Act of 1935 completely rewired the Federal Reserve. It ended the Civil War by centralizing all the power. As you can see in this before and after, authority was basically ripped away from the 12 regional banks and handed to a new board of governors in Washington. The main policy committee, what we now call the FOMC, was totally restructured to give Washington a permanent majority. The regional banks couldn't just opt out of decisions anymore. So the takeaway here is simple. These reforms were a direct response to the chaos of the Great Depression. The goal was to end the Civil War by declaring a clear winner. And from that point on, Washington was in charge, period.
And that brings us all the way to the present day and the unsettled legacy of this 100-year-old conflict.
That powerful, centralized, Washington-led Fed that you see on the news today, it is the direct result of that 1935 power grab. It solved the problem of paralysis, for sure, but that original compromise, that delicate balance between central, regional, and banking interests, it was never fully erased. The tension is still baked right into the system. I mean, think about it. Every single time you hear a debate about whether the New York Fed has too much influence, or whether the regional bank presidents should be political appointees, or how much say local business leaders should have, you are hearing the modern-day echoes of that original Wilsonian compromise. The Civil War never really ended. It just became a permanent, low-grade political debate. And that leaves us with one final, really critical question. The system that we have today was designed to solve the problems of the 1930s. But as we face completely new challenges, things like digital currencies, global pandemics, climate risk, is a structure that was forged in the fire of that one crisis still the right one for our future? That is the unsettled question that still sits at the very heart of the Federal Reserve.